Coreweave just dropped an absolute monster quarter, with a revenue backlog that is simply off the charts. But buried deep in the details is a critical operational delay that has forced them to cut their full-year guidance. This exposes a massive execution risk that you, as an investor, absolutely cannot ignore.
Okay, so let's really dive into this, because this slide gets right to the heart of the matter. It's the core tension for Coreweave right now. On one side, you have this historic, almost unbelievable demand for AI compute. And on the other, the very real, very physical challenge of actually building out the infrastructure fast enough to meet it.
The top-line numbers are just staggering. And it all starts right here. For the third quarter, revenue hit an incredible $1.36 billion.
And get this, that's a 134% surge compared to the same quarter just 1 year ago. I mean, that's a crystal clear sign of just how explosive the demand really is for their specialized AI cloud platform.
But this is the number that truly tells the story. A revenue backlog of over $55 billion. To put that into perspective for you, they added over $25 billion to that backlog in the third quarter alone. That's not just growth, that is completely unprecedented.
So let's start with the bull case, right? It's powerful, and it is built completely on this foundation of just historic, validated demand. On the earnings call, you have the CEO, Michael Intrater, framing this performance as proof of their market leadership. He said, and I quote, "Their position as the essential cloud for AI has never been stronger."
Now, who is behind that backlog is what's really telling. I mean, look at this. These aren't just prospects on a list. We're talking about massive, multi-billion-dollar commitments from the absolute titans of AI, Meta, OpenAI, and other hyperscalers.
And you can see that accelerating momentum right here on this chart. It's not just growing. The rate of growth is actually getting faster every single quarter. That demand curve, it is getting steeper by the day. And for any investor watching, this is a really key metric. Management went out of their way on the call to stress that they are actively de-risking their customer base. Think about it. Dropping your concentration on a single customer from 85% of the backlog all the way down to 35% in just 9 months, that is a huge, huge step.
All right, so let's flip the coin. Let's talk about the other side of this. Because for all that incredible demand, the operational challenges of meeting it, well, they are starting to show some cracks.
It's the question every single investor has been asking. What's the catch here? What could possibly derail this growth engine? Well, the Q3 earnings call gave us a pretty clear answer.
The problem is a temporary delay, their words, from a single third-party data center developer who's behind schedule. So let's be clear. This is not a demand problem. This is a delivery problem, and it's having a direct, tangible impact on their near-term results.
So here's how that one delay translates to the numbers you see on the screen. Both their full-year revenue and their capex guidance have been revised downward. What does that mean? It means they're effectively pushing a significant chunk of activity and spending into next year.
This delay also really shines a light on the company's financial profile. On one hand, they are operationally a beast, posting a massive $838 million in adjusted EBITDA. But, and this is a big but, the sheer cost of scaling this fast means they still reported a significant GAAP net loss of $110 million for the quarter.
So when you're faced with this very real bottleneck, the key question becomes, what is management actually doing about it? How are they responding to protect that massive backlog and, future growth?
Well, they laid out a very clear 3-step plan. First, they're diversifying their suppliers so no single partner can cause a major disruption like this again. Second, they're taking more control by, get this, building their own data centers. And maybe most critically, they got the customer who was affected to agree to the new schedule, which preserves the full value of that huge contract.
But the CEO was also really candid on the call, which I think is important. He positioned this not as some Coreweave-specific failure, but as a problem for the whole industry. His exact words were, "The challenge is the power shell." He's talking about the physical data center buildings themselves, and he's saying this is a bottleneck the entire industry is going to be fighting for the foreseeable future.
So, okay, what does this all mean for you, the investor? When you strip everything else away, it boils down to this one fundamental tension. Epic demand versus the cold, hard physical reality of delivery.
And this right here puts the entire situation in a nutshell. The bull case is crystal clear. You've got insatiable demand, a massive contracted backlog, and proven technical leadership. The bear case? It's just as clear. These systemic supply chain bottlenecks are now a proven risk. Execution at this scale is unbelievably difficult, and, well, it all requires a mountain of cash to fund.
And that leaves us with the final, critical question that is going to define not just the next quarter, but the entire next chapter for Coreweave. They have proven, beyond any shadow of a doubt, that they can sell. The multi-billion-dollar question for every single investor now is, can they build fast enough to deliver?